Right, hi guys. Today we're going to be talking about super traders stroke unicorns in terms of the perhaps retail or leisure market world. And what do I mean by this? Well, I'm talking about your high street locations, let's say, or even shopping centres or anything where you've sort of got those sorts of trades, and where you've got a mixture of really local retailers or operators versus your kind of multi-chain nationals like your Starbucks, Costa Coffee, McDonald's, that kind of thing. This is particularly prevalent in the sort of leisure and sort of restaurant sectors that I'll be discussing today. I'm talking about kind of affordability and these kind of super companies who have really big, they're a really big entity, they have a lot of backing, they have multiple sites, and talk about their ability to kind of sustain sort of fixed property costs going forward, and how they kind of set the tone for the rental market, and what kind of effect that has on the independent and smaller operators. So I'll give you an example. You'll have, let's say, a trading location. It could be a high street, for example, with a number of operators on there. There's a property that's vacant to let. A super trader will come in, assess the market, think, great, yeah, there's a bit of competition for this space, but I like it, I want it, I think I can do well there. They will pay, for example, a significant market rent, perhaps way above what's been agreed traditionally in that particular stretch. They'll go in, they'll give it a go, and one or two things will kind of happen. They'll either trade amazingly well because they're effectively a super trader, and they've got a really hot business model, and they can afford to kind of make the profits to sustain that kind of cost level. Or they won't do so well, but actually they'll be stuck with the lease, and they'll just have to stick it out for a reasonable length of time. It might be 3 years, 5 years, 10 years, whenever it is that their lease allows them to get out of that lease. It could be a break option, it could be lease expiry, but that's the earliest time they're going to be able to exit from that bit of pain. But in the meantime, they can keep themselves going because they're a big entity, so they're making profits in other stores. And okay, they made a bad business decision this time round, but that's fine. They'll just have to live with it, and they've still got a brand presence in that location, even though they're not making money or profit, as it were. But that's just a bit of a rough patch they've got to ride out with that property. Now, that's all well and good for that operator, but what kind of effect does that have on other businesses? And this is a problem we've had, I think, in this country for a long time, and I can't really see it changing anytime soon, unfortunately. You've got other operators, and they won't necessarily have the support or level of sort of logistics and processes and systems in place as the bigger companies will have, and they just can't afford those kind of rents. So what that means is, when it comes around to sort of the next round of rent reviews, for example, to open market level across that trading location, what happens is the tone gets set based on recent lettings, and if that super trader has paid an above market rent, which they often do, sometimes significantly so, then that kind of sets the new tone for the rest of the street or that location. And for those operators that just haven't got that kind of nous and can't afford to sustain the kind of losses that the bigger operators do on an overall level, it's incredibly tough for them to keep afloat. So what you end up with is independent retailers either going bust very quickly, soon after those sort of rent reviews, or they basically don't make any money. They run at a loss for a period of time. It could be 6 months, a year, 2 years, 3 years, as long as they're happy to go on for, or as long as they physically can. Quite often getting themselves into an awful lot of debt in the process, just to try and cling on to what they once built. And then, they go bust, and then someone else comes in at perhaps a lower rent, or again, another super trader will come in and think they can do a better job. And that does, unfortunately, create a little bit of an inflated market, which is unfortunate because you do kind of need to look at the overall tone of that trading location to see whether it realistically stacks up and whether operators can afford that kind of trading location. So, because one operator can afford to either sustain losses or trade at such a superior level to most other retailers isn't necessarily, as a market model, isn't always the best idea, for a particular trading location. As far as the wider trading community and landlord investor community is concerned, if you do want, to maintain a sustained trading location, really, with sort of happy trading tenants that can afford to pay their rent. On the flip side of that, really, I am also a strong believer that a lot of businesses do and can get quite comfortable in how they're operating their businesses. And it is sometimes the case that, when you are faced with a rent increase, for example, where your costs do go up, that kind of does force you to reassess how you operate as a business. And it creates opportunity for you to look at different ways of how you can operate the business and how to make it more profitable. And unless you've got that pressure, then you're perhaps unlikely to really push for those solutions. So, I see it as a good and a bad. It does have its issues. I think the market overall, in terms of the model, the rent review system, I think is a little bit flawed. But we kind of have to work with what we have at the moment until we can figure out a better system. And I think for as long as the super traders and unicorns of this world are out there, and I think they're getting more prevalent, by the year in terms of sheer numbers and scale, I think we'll always have that problem. So, I think advice for any businesses going into a particular location is just do your homework. You see what the market rent is, but really crunch the numbers in terms of what you think is affordable and doable, and factor in all the other costs. And don't just think that, please don't assume that the rent you're paying today is the rent you're paying tomorrow, because in terms of fixed costs, you need to see what the location's doing, and you need to do a bit of a stress test and figure out, whether you can afford an increased rent in the future, and put some sensible estimates in there for that, or even consider fixing any uplifts for the future, just so you can really plan for the business going forward, because it can be a big shock later on, when your fixed costs effectively double overnight. Anyway, I hope you found this helpful. If you want to sort of get involved, please do drop me a note and ask any questions, whether they're generic or specific, and we'll be sure to get these topics covered at a later date on any podcasts or vlogs or blogs that we do going forward. Take care.